First, let's define what it is. Dollar cost averaging is the technique of buying a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. More shares are purchased when prices are low, and fewer shares are bought when prices are high.
In essence, the technique works when markets are undergoing temporary declines, because it exposes only part of the total sum to the decline. We call it dollar cost averaging because of its potential for reducing the average cost of shares bought. So to be clear, this practice reduces the risk of investing a large amount of money in a single investment at the wrong time.
No one can accurately predict on a regular basis the day-to-day direction of the stock market. So if you invest a lump sum of money, you can be buying at a low price, but it is also plausible that you can be buying at a high price. So to protect yourself, it is prudent to invest on a more regular basis, such as quarterly, monthly, or even bi-weekly.
When you invest on a regular basis, you actually don't mind if markets fall, because it means your next scheduled purchase will buy more units. It's mathematically forced upon you that you buy less units when the price is high and more units when the price is low. We do this with every other aspect of our lives, but for some reason we won't automatically do it with our investments.
For example, when you need to purchase gas and you get to the pump only to discover the price is high at say $1.50 per liter, you won't fill up your tank. Maybe you fill the tank halfway, hoping that the next time you need gas, the price is reduced to say $1 per liter. At that moment, you will fill your tank to full, thus averaging out the price per liter to about $1.25.
Another good example is when you're at the grocery store. If a reasonable price for a can of tuna is say $2 per can, and you normally buy 2 cans, but you go to the grocery store and the price is increased to $3 per can, you may only buy 1 can of tuna that week. Similarly, if the price has been reduced to $1 per can, you would stock up and buy 4 cans of tuna that week.
In our industry, people do the exact opposite because they let their emotions dictate their investment policy. When markets are shooting up to all-time highs, people invest heavily because greed takes over and they expect markets to just keep going higher and higher. Conversely, when markets are falling, such as in the crash of 2008 and 2009, people will not invest any money because they let the emotion of fear take over and are afraid that their investment will just keep dropping in value. In fact, that's the ideal time to buy, and wise investors such as Warren Buffett jump in and take advantage of this huge buying opportunity.
Dollar cost averaging therefore helps take the emotions out of investing. That's why we highly recommend you implement the investment strategy for your own portfolio. It's also an easier way to save money. By having a small amount of money withdrawn from your bank account on a regular basis, you won't feel the impact of it on your overall finances, as opposed to trying to save a large sum of money for the end of the year. With automatic withdrawals, since you don't see it, you're less likely to spend it. And most mutual funds will let you invest for as little as $25 a month.
So that's it for today. Be sure to check out our Facebook page for regular updates. Thanks for stopping by, and we'll talk soon.